Your complete beginner's guide to investing. Clear answers to common investing questions. No jargon, no confusion, just straightforward guidance to help you start your investing journey. Core getting started questions. The essential questions every beginner asks when they first consider investing. How do I start investing with X? Or where do I start if I know nothing? The simple answer: start by building a foundation. Have an emergency fund, 3 to 6 months of expenses, pay off high-interest debt, then begin investing even with small amounts. Step 1. If your employer offers a 401k with matching, contribute enough to get the full match. It's free money. Step 2. Open an IRA, traditional or Roth, at a low-cost brokerage like Fidelity, Vanguard, or Schwab. Step 3. Choose a simple, diversified investment like a target date fund or total stock market index fund. Step 4. Set up automatic contributions so investing becomes a habit. Key insight: you don't need a lot of money to start. Many brokerages have no minimums, and you can buy fractional shares of funds for as little as $1. Should I invest or pay off debt and build an emergency fund first? Step 1. Get the employer 401k match. This is typically a 50 to 100% instant return. Step 2. Pay off high-interest debt, above 7 to 8%. Credit cards, personal loans, etc. Step 3. Build an emergency fund, 3 to 6 months of essential expenses in a high-yield savings account. Step 4. Invest for the future. Max out retirement accounts, then taxable brokerage if desired. Exception: if your debt interest rate is low, like a 3% mortgage or 0% car loan, it often makes sense to invest while making minimum payments, since long-term market returns historically exceed those rates. Key insight: paying off high-interest debt is a form of investing. You're earning a guaranteed return equal to the interest rate you're no longer paying. Is now a good time to invest, or should I wait for a crash? The straightforward answer: time in the market beats timing the market. If you have money to invest and a long time horizon, the best time to start is usually now. Nobody can reliably predict crashes. Even professional fund managers fail at this consistently. Waiting often costs more. Markets trend upward over time, so waiting often means buying at higher prices. Missing the best days hurts returns. Many of the market's best days occur shortly after its worst days. Regular investing smooths the ride. Dollar cost averaging reduces the impact of buying at any single price. Key insight: studies show that even if you had the worst timing and invested only at market peaks, you'd still be ahead of someone who kept waiting for the perfect moment. What type of account should I use? 401k, IRA, Roth IRA, brokerage. General priority: 401k, up to match. HSA, if eligible. Roth IRA. Rest of 401k. Taxable brokerage. 401k, 403b. Pre-tax contributions. Traditional IRA may be tax deductible, taxed on withdrawal. Roth IRA, after-tax contributions, tax-free growth and withdrawal. Taxable brokerage. No special tax benefits. Flexible access. What's the difference between an IRA and what I invest in? Think of it like a container and its contents. The account container. An IRA, 401k, or brokerage account is like a special box with certain tax rules. The account itself doesn't earn money. It's just a place to hold investments. The investments, contents, stocks, bonds, mutual funds, and ETFs are what you put inside the account. These are what actually grow or shrink in value over time. Common mistake: opening an IRA and leaving the money in cash, not invested. Money must be used to purchase investments inside the account to grow. How do taxes work on investments and dividends? Tax treatment depends on the account type and what happened. In retirement accounts, 401k, IRA, no taxes due each year. Traditional accounts are taxed when you withdraw. Roth accounts are tax-free on withdrawal. In taxable brokerage accounts, dividends taxed in the year received, qualified dividends at lower rates, ordinary dividends as regular income. Capital gains taxed when you sell for a profit. Short-term held less than 1 year taxed as income. Long-term held more than 1 year taxed at lower rates, 0%, 15%, or 20%. Unrealized gains, no tax until you sell. Paper gains don't trigger taxes.